Tesla is one of the most mind-blowing, innovative and futuristic company, and in the back of our heads we all are deeply assured that Tesla is gonna prosper real soon seeing the way it's growing. Nevertheless, here's the thing. Would you pay $20,000 for an iPhone 13 when it costs just $1,000 in the US? No, that's nuts. The price is mentioned on the box as well as on its website. You don't have to be fooled and pay 20 times what it's worth. Now, just because Tesla is trading at around $900 doesn't mean it's worth $900. Here's the thing. It's very easy to find the fair value for an iPhone, but how do you find the fair value of stock? Well, in order to find that, we'll be calculating the company's intrinsic value, which is a way of finding out what would be the stock fair value after analyzing the fundamentals of the company, which basically is its revenue, earning, cash flow, etc. There are many ways to find the intrinsic value of a company, but we would be using the method by which Warren Buffett himself uses to evaluate a stock, called the discounted cash flow method. When a stock is being valued, it is generally valued for its future potential, what it could be worth 10 years or 20 years down the road as compared to what it has achieved currently. Hence, when we are calculating its intrinsic value, we are basically estimating what it's going to be worth in the future, which would require us to make some assumptions. Like at what rate is the company gonna grow? Usually an average good stock could have a 10 to 15 compound annual growth rate. Some really good stocks could even grow at a rate of 30 or 40% per year. But seeing Tesla's incredible past performance, and its past 5-year CAGR of 50.8%, which is absolutely insane. Yet according to Yahoo Finance analysts, they have predicted a growth of 79.25%, which is nuts. That's like saying company's net worth is almost gonna double every single year henceforth. Anyways, let's go super optimistic and go with a growth of 79.25%. And when we calculate its intrinsic value, we get $165 per share, as compared to its current market price of $920. And this ain't just it. Warren Buffett recommends to always use a margin of safety. As you know, valuation of a company is based on future predictions, and that might be different from the actual values. Hence, we need to always buy at least 30% below the intrinsic value, giving it a margin of safety. Which means unless Tesla's share price doesn't go below $115 per share, it's gonna remain overpriced. This is just one of the methods to calculate the intrinsic value. There are many other methods, some as simple as an indicator which calculates the intrinsic value for you. The indicator isn't as accurate as calculating it yourself, but it's good enough for when you just want a rough idea of how much is the intrinsic value roughly. The blue line is the intrinsic value and the green line is the price after calculating the margin of safety. As you can see here, according to this indicator, Tesla's intrinsic value is at just $50 and the margin of safety is at $35 as compared to the current market price of $920. The current market price being at trendline support would have been a good point to enter provided it was priced according to its valuation. Also, a regular stock generally have a PE ratio of around 25 to 40. When the PE ratio is at 20, it's an indication that the stock is slightly undervalued and could be a good time to buy. And when the PE ratio goes to 50 or 60, it's an indication that the stock is overpriced. Now, when we have a look at Tesla's PE ratio, we get an insane PE ratio of 301. This just shows how crazily overvalued is Tesla's share. Now, this doesn't mean Tesla is a bad stock. In fact, it's one of the most wonderful stock out there, and no wonder people love it so much that they are willing to pay such a heavy premium for it. I wouldn't even be surprised if Tesla's share price more than triple within the next 2 years, and that's because currently everyone is blindsided by Tesla's incredible success. But the day something goes wrong with Tesla, people will start to realize how overpriced the stock is and it would crash massively. As I have learned from Warren Buffett and many other world-class value investors, the most important rule in investing is to protect your money at all costs. And the way to do that is by only investing in stocks that you get a fair value for what you pay for. Hope you found this video useful. Many more trading and investing videos on Wealth Trader. Hit the subscribe button to stay tuned.